here sharing with you on the Tiger platform regarding investing in ASEAN's resilient economy, because we understand that most investors are always looking at the US market or the Chinese market because they are much bigger capital markets in the world. And but today, let's talk something outside of that, because we have seen that the two markets have been very volatile this year. And on the other hand, the ASEAN economy as well as stock market were a lot more resilient. So that may came as a surprise to many investors. But today is introductory to these ASEAN stocks. I'll cover 10 of them. So if you are not familiar with the ASEAN stocks, don't worry. Okay, so today you'll get a good flavor of what's to come. Some of you may be more experienced in investing in ASEAN, and feel free to chip in some of your views, your comments, and you have any question, feel free to ask them as well. Okay. So I'm Melvin, a CEO of Dr. Wealth, and I'm also an SGX Academy trainer. I've invested in the stock market for over 15 years, been through the financial crisis, COVID crash, and the current crash right now, right? So I have a lot of experienced a lot of events in the markets. So I've also written books like Secrets of Singapore Trading Gurus as well as Singapore Permanent Portfolio. You might also see me in some of the Singapore media, right? So I'm based in Singapore. And this is the GDP forecast for the ASEAN nation. So in ASEAN, there are 10 nations, okay? They are the Southeast Asian countries, of course. And these are the forecasts, not the final numbers, but this is the GDP forecast. As you can see, all of these economies are experiencing growth in 2022, even though globally the growth seems to be slowing down, especially in the US and China as well, right? But you look at Southeast Asia, you have some countries like Vietnam that is expected to gain 7.5% GDP growth, with Philippines 7.4%, Indonesia at 5.2%, Malaysia at 5.3 to 6.3. These are rather high numbers, right? These are not low numbers. And in an economic downturn or economic recession that's looming, these are considered very remarkable GDP growth, right? So that means that there might be some defensive plays of safety, relatively safer stocks that we can dig in the ASEAN markets. Okay, so that's what I'm going to discuss today, right? But you must be you must be also aware that Southeast Asian stocks or ASEAN stocks are not known to be super exciting, fast growth kind of stocks, but they do provide those kind of steady growth. Okay, so that's what I'm going to focus on more today. And this is the index performance year to date. I took this, I think, last Thursday or last Wednesday, right? So timestamp first week of October, from January this year to October first week. So we can see that Indonesia is still up 7.7%, right? STI, Straits Times Index from Singapore, is up 1.4%. Okay, I think today is slightly down a bit, right? But still, compared to say US or China, it is down like 20% to even 30%. Okay. And we do see some, like Vietnam did have a larger drawdown, but in general, if you look at the Southeast Asian stock performance this year, they are relatively less damaged as compared to the US and the Chinese stock market. Okay, so that's why I say that there might be more chances that you can seek some refuge in the Southeast Asian market. And you might also consider diversifying, right? Not just putting all your investments into one or two countries, but spread it out. It might give you a different kind of exposure, because we also know that through history, every country will have a different, or should I say that every year you will have a different country outperforming the rest of the world, right? And this, it is not necessarily always US, it's not always China, right? It can be any countries, right? So by spreading that capital out more, you can get this chance of riding on any markets that is outperforming for that particular year. So my views is that, as I said, don't expect the ASEAN stocks to be the most exciting growth stocks out there. ASEAN stocks tend to provide a lot of value and dividend plays because they tend to be more matured companies. Okay, but that said, there are some that are growth stocks, but they are also not those very fast growing. They are more like a steady grower. They are usually in tried and tested industries, not so much in the technology space. But in essentials, like it could be a commodity related company, it can be a property developer, those kind of very established industry, and they have a good foothold, or they may even be having a very large market share, such that they are so dominant. And that's what makes them defensive as well, right? Because it's very hard to capture their market share away from them, in other words. So I'll quickly run through 10 of them, right? It is not meant to be a recommendation, just be clear about that, okay? So nothing that's presented today is worth to be advice or recommendation. It's more like to give you an idea what are the stocks that are out there. And if you are interested, please go ahead and do more study and make sure that you really understand what you're getting into before investing. Okay, so today, treat it as more of an introduction, and I'll share with you some of the views how I see these companies. Okay, so the very first stock that we want to cover is this company called Emperador. Right, so Emperador, it has always been listed in Philippines, right? It's a Philippine company, and sometime 2 months, last month, right? It was added to the Straits Times Index. Okay, so Straits Times Index is the Singapore stock index. There are 30 companies. So getting into it is considered rather larger company compared to many of the other companies listed in Singapore. And they are also listed not long ago in Singapore via a secondary listing a few months ago. Okay, they were added to the index component in September. And what do they do? As the picture suggests, I put here some pictures for you, right? And this is a whiskey, okay, and this is the brandy, right? So for just your information, okay, whiskey are made from beer, right? So they distill beer and then they make whiskey. Then for brandy, they actually distill the sugar cane. Okay, so the raw material is a bit different. The taste, of course, is different, but to many people, it's just hard liquor, right? Spirits, where the alcohol content tends to be higher, 40% and above, right? Those kind of numbers. Okay, so majority of their revenue comes from brandy. So this screenshot is taken from Tiger. So if you are using the Tiger brokers, which I suppose you do, right? That's why in this webinar itself, and we would see some useful things that I show over here. Like I always like look at the segments, right? Because some companies, they have a lot more revenue streams, and it is useful to see where do they make most of their money. So in this case, you can see that Emperador, 68% of the revenue comes from the brandy, right? Brandy sales. And then the 34%, another 1/3, comes from whiskey. Okay, so the whiskey is more international. The market is and the whiskey come from Scotland, right? So most of the brands come from Scotland, like your Jura, like your Delmore. All these are the Scottish brands, right? And also because the Scott whiskies are the best known or the most popular among drinkers. So these are the makeup. So they really focus mainly on hard liquor, not even the wine or beer, right? They are very focused on this hard liquor itself. Okay, and the margins are good, right? So before we talk about margin, let's look at the revenue growth, right? So their revenue compared to quarter, based on the second quarter, right, they have up 19%. If based on first half, is up 11%. So there's some acceleration in quarter two. But 1 quarter or 1 year, not much difference, right? So we want to look at a longer period of growth. So over a period of 5 years, and this is including the COVID period, and the compound annual growth rate, you see a lot of this term I use, CAGR stands for compound annual growth rate. That means you can say there's the average growth rate per year, but it's a compounded in a sense, right? So which means the percentages, usually the number look a bit smaller, and it's about 6.4%, right? So if it's not, say, a very fast growing kind of number, right, I would say at least 10+%, then you can consider it reasonable, fast enough growth, right? But if 6.4% over a span of period, it's faster than the GDP growth, right? But it is just more steady in that sense. Okay, so as I said, they are not those kind of exciting stocks, right? But they do provide those kind of steady growth even over the COVID period. So that's something to consider. And they have the internationalization potential because, as I said, the Scott whiskey, right, is targets the international market. Okay, so for ASEAN companies, most of them have their majority of their revenue derived from Southeast Asia, but some of them, like this Emperador, do have some international exposure. Okay, of course, pros and cons, right? International exposure means that you have a bigger market, but on the other hand, there may be more, you're more exposed to certain risks, right? Like now we know that in Europe, there's a lot more chaos over there. Then also some of the currency risks, right? When you are exposed to a foreign market, you also exposed to their foreign forex risk as well, right? So it's a pros and cons, but in general, I always prefer that a company have a more global reach, right? Because the benefits outweigh the negatives most of the time. Okay, and the next thing is that you can see the profit margin is for hard liquor is actually pretty good, right? So even though the profit margin have came down due to the rise of the inflation, and that means that the cost materials has gone up, right? The cost of the materials have gone up and lower that margin. Okay, but still rather good, right? 18%, 20%. It's comparable to another whiskey company called Diageo. Okay, the margins are around the same. Right, so it shows that hard liquor does provide very good margin. Okay, high price, low cost. Okay, so that's where the margin comes in, and the growth rate for the profits is also quite in line with the revenue growth rate. Right, so 6.4, 5.3 is about there. Okay, so that's why I say they are steady growers. So this is a steady grower type, and currently, unfortunately, it's overvalued in my opinion. Dividend yield 1.6%, but you buy this stock is not for the dividends. Okay, because the payout ratio is not very high, it's 0.2, which makes sense because you still have some growth, right? And it makes the management should retain most of the earnings and redeploy into the company and find more growth, right? So this is acceptable, and that's why you don't buy this for dividends. It is more for that kind of growth, right? And then for P ratio is about 32, and its 10-year average is about 21. Okay, so it is slightly on the higher side, right? So you might want to study it further or even do more detailed valuation, right? If you want to pursue this. Okay. Next company, let's still stick to the alcohol company, that theme. This Thai Bev has been listed in Singapore for many, many years. Can't even remember when they started, decades, definitely more than 10 years. And it's from Thailand, as the name suggests. And it's also a Straits Times Index component, right? Which means it's also the top 30 traded market cap in Singapore market. And unlike Emperador, it does have other beverages. Okay, that includes the beer, the Chang beer, you might be very familiar with. If you live in a region, right, they do export to quite a lot of countries in the ASEAN region. And they also have the Thai hard liquor, right? I don't know what it is made of, right? It's just a very unique spirits, okay? It's not brandy, it's not whiskey. I'm not sure what's the ingredient over there, but it's quite popular, right? Majority, a good part of revenue are derived from this. Okay, they also have some whiskey, Scotch whiskey, right? Old Pulteney. Okay, so this is also an international brand. And beyond just these spirits and beer, you can see that they also have another segment called the non-alcoholic beverages, right? So they do have like mineral waters, they do have like investment in Fraser and Neef, soft drinks, quite a wide range of beverages, right? So they really focus on beverages. Okay, although they have some food. I think there's a KFC franchise in Thailand, right? They acquired it just a few years ago. They are probably expanding beyond just beverages, but you can see majority of the revenue comes from alcoholic beverage. Okay, that's like good 88%. That is their core business. And this is their revenue growth. Likewise, I screenshot this from Tiger Brokers, the app itself. You can see the growth 2017, 18, 19. Then 2020, that's where COVID happened and stretched into 2021. Right? So it is understandable that during this period, their revenue come down. It's still quite resilient, as you can see, is at least it didn't come down like 50%, 30%, right? It maybe come down by less than 10%. Okay, so it's rather resilient even during COVID period. You must understand that during COVID period, a lot of places are closed, right? Tourism, when it lowers the consumption as well. The bars were closed. That also means lower consumption of alcohol. So it is quite amazing that it only reduced just 10-20%. Okay, during a very, very serious crisis that hit this kind of a beverage company. right? So oh yeah, actually it's here, just dropped 5%. Okay, so it's really quite resilient in a sense, right? And prior to that, they've been growing well, and some is via acquisition, okay, which I'll share a bit more later. 5-year CAGR is about 4.8%. Okay, so it's again a steady grower, right? And considering we are taking that number of 2021, okay, so it's a lower number, right? If COVID never happened, probably the growth rate will be higher. Okay, so consumption and demand affected by COVID, 2022 have seen some rebound, right? That's a good news, okay, because first half, we only have first half data, revenue is up 9%, earnings up 14%. Okay, so it seems like the growth is coming back again. Right? Hopefully, they can surpass the previous high, which is in 2019 figures. So they have been acquiring to grow, right? And I said they have this F&N, non-beverage, non-alcohol beverages. Okay, so this is quite a famous brand in the ASEAN region as well. Be it soft drink, isotonic drink, concentrates, all this. Okay, so they managed to buy this many years ago. Okay, and have a controlling stake in this. They don't own 100%. The stock is still listed, but they have a controlling stake. Okay, it is a subsidiary of Thai Beverage. And then there's also they bought this Sabeco Saigon beer, right? Known for it's the number one beer in Vietnam. Okay, so the thing about ASEAN, something that you must be aware of is that many of these companies they are in a tested industry, right? Like in this case, is alcohol, okay, or beer, right? In each country, there is actually a dominant beer player. Okay, like for Singapore, it's Tiger Beer, right? And it is very difficult for a brand in one country to expand into another country. Okay, because there is already a dominant player in each of them. Right? In Indonesia, you have Bintang Beer. Okay, so how do they expand within the region? The best way, right? Not necessarily the best way. I would say that the very obvious way is to acquire. Okay, is to buy over the entire company. Then you buy over the market share, right? So that seems to be the strategy of Thai Beverage as well. That's why they have been on an acquisition spree in the past 10 years. Okay, so that includes the Saigon Beer. But that comes with a price, right? The price is that, let me just cover this part first. The debt level is high because they were doing the leverage buyouts. Okay, so they borrow a lot of money to buy over a competitor in a new market. Right, so a lot of all these are debt-funded acquisitions, and their debt to equity is higher, right, about 120%. Okay, it is high among the F&B industry. Okay, so usually F&B industry, the debt to equity is not that high, maybe 50% or even less, right? So for Thai Bev, because of the acquisition they have done over the years, they have piled on the debts as well. And this is not a good sign because interest rate is rising, right? Okay, so they will get hit in some of these financing charges. So this is one of the risks. And there were rumors that they are trying to spin off the beer segment, right? That could free up some equity and reduce this debt level as compared to equity side. And can also use the proceed to pay down some debt. Or another rumor is that they are also trying to sell off the Saigon beer, which they required a few years ago, okay, to reverse it, right? So that could also reduce that debt level. So this is, at the end of the day, still a steady grower, right? Just like Emperador. And unlike Emperador, it is fairly valued. Okay, the payout ratio is higher at 0.5. That means every dollar they earn, they give out 50 cents, or they had in the last year gave out 50 cents for every dollar they earn. And the dividend yield is about 3.1%. Okay, so it has some growth and the dividend is also rather high, right? So it is a good mix of both capital gain and dividend gain, right? I would say that it's quite balanced. And the P ratio is 16, but the 10-year average is at 18. Okay, so it is slightly lower than the average. Okay, so you do have some capital gain, you do have some dividend gains as well, right? So that's what make it balanced. But take note of the risk level, which is the debt is on the rather high side. Next, the third one is Wilmar. This is a vertically integrated palm oil company. It's also an STI component, one of the top 30 companies in Singapore. Okay, and it's based in Singapore, right? Unlike the first two, one was based in Philippines, one was based in Thailand. Okay, and this company, they really extract everything. They do everything. They have palm trees. They grow the palm trees, and then after that, they harvest them. They also have the milling factories, right? Crush the palm oil, take out the oil, and then they use the oil to make food products. They make take some of the chemicals to go and make dishwashing liquid, cleaning liquid. They take some of the oil and make biodiesel, right? Those kind of petroleum products, and they also get some of the items from the palm tree, or the crude palm oil, to make the animal feeds as well, right? So they do a lot of things that's related to the palm oil industry. Okay, so they are that vertically integrated, and which means they're quite diversified, right? They have B2B business, they have B2C business, spanning different kind of industry, F&B to animal feed to consumer cleaning products to energy, to like your fuel for the cars. Okay, so rather diversified, even though they really focus on just palm oil, right? So majority of the business come from the feed and industrial products. Okay, you'll see that why it added up to more than 100%, right? Is because there's an inter-segment elimination, right? That means there's some double counting. Okay, because to some customer they may buy from both segments or even 3 segments, right? So there's some double counting that they need to deduct at the end of the day, but the majority is still from feed and industrial. Then the second one is food products. Okay, so they have this arowana brand which is also listed in China, right? I think what do we call it? Yihai Arowana, Yihai Carrier Arowana, something along that line, right? So it was listed a few years ago. Okay, the spin-off did well for them. It is one of the major cooking oil brands in China, right? So they do have Asian reach. I wouldn't say global, but the Asian reach. Okay. So this is their growth rate, right? You can see it's pretty steady, even though there was COVID in 2020, right? In fact, there was a frenzy of people stocking up cooking oil because of all the lockdown considerations, right? And in 2021, because of the inflation, they did very well, right? They got record revenue and record earnings. Okay, so otherwise, without this sudden bump of inflation, the revenue would not jump that much. So you can see that this company can be a hedge against inflation. Okay, so because they benefit from inflation, right? The crude palm oil prices go up because they own the plantation, so they can sell the palm oil at a much higher price. Their margin expand because the cost of production may not rise as fast as the selling price. So that's how they expand their margin as well, right? So this is one of the inflationary hedge kind of companies out there. I would classify this more like a dividend stock, even though you can see that there's some growth, right? But the growth tends to be cyclical. That means only when there's a commodity price boom, then you will see a sudden surge in their profits and revenue, right? Other than that, we should just be more conservative and treat this as more like a dividend player, okay? And currently it's fairly valued, right? Dividend yield of 4.2%. Okay, the payout ratio looks low because of a record earnings. Okay, but don't expect these earnings to repeat year in, year out, only during inflationary period. P ratio 8, average 14 also looks cheap, right? But you will realize that I never say that it's undervalued. I say it's fairly valued. The reason is because it has a very exceptional 2021. Okay, it's based on this exceptional 2021, which may not repeat next year or this year. Okay, it depends on how this inflation problem come about, right? Maybe it's still may see some growth, right? Maybe you can see 1 or 2 more years of high revenue and profits, but beyond 22-3, it's a question mark, right? Whether inflation will sustain, considering that interest rate has been rising aggressively, right, to tame inflation. Okay, so it might not be a bumper year after 2023. Okay, so it tends to be that having that cyclicity. So I would say that be more conservative, right? When valuing this kind of company. Now they are on the top of their cycle. Okay, so you must put some margin of safety in your valuation. So historically, over the past 5 years, their yield, the highest yield was around 5.4%, right? And given that current interest rate is rising, right, you might want to demand a higher dividend yield, right, to have a buffer against a rising interest rate environment. So maybe taking this highest point as a reference, at least 5.4% or even 6% would be a good price to lock in for this kind of steady stocks, okay, and inflation beneficiary kind of stock. Next one, This is based in Malaysia. It's called IHH, and they are known to run private hospitals. And these private hospitals are rather prominent brands, okay, very well known and renowned in the region. They benefit a lot from the medical tourism, right? For example, in Singapore, because it is one of the countries in the ASEAN market with top-notch medical care, right? The expertise, the specialists are here, and that have a lot of attract a lot of tourists to come here and seek medical kind of care. Okay, so you can see that Singapore revenue is the highest, 30%. Then in Europe, it's another quarter, right? Then in India, it's about 1/5. Then in Malaysia, it's about 16%. Okay, then they also have some presence in other countries like China, right? So, but majority you can see are in Singapore. Okay, that's the largest, right? Even if you add Malaysia to Singapore, that's as good as half already, right? So majority of the revenue comes from Southeast Asia. Okay, they do have some international exposure, right? In India, Europe, and China. So there are the brands that are well known in Singapore will be like Mount Elizabeth, Glen Eagles, right? So these two are like the one of the highest tier kind of private hospital in Singapore. Okay, so the benefit of this kind of business is that we all know, okay, whether the economy is good or bad, when people need to see a doctor, they will see a doctor. Okay, so their earnings and their revenue will be a lot more resilient than a lot of stocks out there. Okay, so that's why I focus more on the resiliency part of it. Okay, given that now the economy is not as steady, right? Not as prosperous as before. Inflation is still high, right? So that's where I think majority investors are more interested in these kind of defensive stocks. So this is their revenue, right? They have again pretty steady growth, okay, but this growth is much higher than all the other stocks we've gone through so far, right? So it is above 10%, okay, 11% per year in the past 5 years, okay, rather steady, and they can and you see a dip in 2020. Otherwise, they have been growing every year, and this is normal because during 2020, medical tourism was not available. Many countries don't accept foreigners, right, to fly in. Okay, and that caused some of these private hospitals those kind of appointments that they could have made money. Okay, but you can see the bounce back very fast, right? Because those people who can't see doctor has been putting it off, and when it is okay to fly again, oh, they just really rush for the gates and see the doctor, right? Get it done. Okay, so if not for COVID, I would believe that 2020 was a growth year for them as well. So you can expect this ING every year they will grow, okay, unless it is a very significant event that affects medical tourism. Okay, but during recession, all this, I think as long as they can fly and see doctor, they will do it. And there are some mega trends, okay, that helps this IHH as well, right? So they will be able to expand by acquiring more hospitals, okay, because they have a very strong experience and competency in running private hospital, right? They can just do it by opening more to expand revenue. There are some mega trends, as I said, okay, the tailwinds are first aging population. Many countries are aging, and that means that the demand for medical care will go up. Okay, not go down, but go up, right? And second is that there's rising affluence, which means that those people will increasingly find it able to pay for private rates rather than having to go for public hospitals, right? Because if you can afford it, definitely you want better care, right? You definitely demand more experienced specialists, right? So as long as the pocket allows, okay, especially for those kind of more death-threatening kind of diseases or illness, right? So that is why I think that companies like IHH will benefit from these trends. So it's a growth stock and it's currently fairly valued, right? Again, you don't buy this for dividend. The payout ratio is not high, 0.25, and P ratio is at 26. 10-year average is 79. Well, it looks like it's very cheap, right? But that's because maybe in the last 10 years it was more overvalued. Now it came down a bit after COVID. And relative to another private hospital listed in Singapore, with Raffles Medical, P ratio is about 24. So I find it very common. Usually medical stocks, they trade at a higher premium as compared to many other industry. Okay, maybe due to their resiliency, right? Trading at P ratio of 20 plus is very normal for medical related stocks. right? So it is very valid. Next one, an Indonesian company, Joe Energy, and they make a very simple product. Okay? They don't even make it; they dig it out from the ground, right? Coal, okay? And coal is used in China, right? Majority of the energy sources, the majority of the energy extraction comes from coal, and India also use a lot of coal, right? So you can see that majority of Joe Energy's revenue come from China, 72%, 15% from Indonesia, right? So this is a different exposure, right? Indonesian company, but exports majority of the coal to China, because as you know, China is the world's largest energy consumption country, because China makes a lot of things for the rest of it's a factory of the world, right? And they require a lot of energy to keep this factory running and producing, right? And coal is the key source, okay? And another thing is that why there's a sudden surge in the demand. Okay, you can see this is sales in terms of million tons. Okay, so the quantity went up, right, by a good 30%. Okay, no, it's a good 50%. Okay, a good 50% increase in the volume. Okay, the reason is because China also used to import coal from Australia, but due to some issues, they stopped importing and they look to Indonesia. And that's why Joe Energy benefited a lot when China imported more coal from Indonesia, right? And then they were also helped by inflation, because inflation drove the prices of the coal up, not just the demand, but also the prices, okay, because of the supply chain issues, right? So the revenue doubled, okay, in terms of dollars, right? So they have both going on with them, going for them. One is volume expansion, then volume times price will give you even higher revenue, right? So that was a double good thing for them. And their profits, of course, shot up. Okay, their profit shot up even more. Okay, that's like I don't know, compared to 21.9 they lost money now. So from 1.8, that's like a 4x. Okay, 400%. So that margin expansion even crazier, because of they got the economies of scale, right? So that is the story, okay? And coal prices remain elevated, right? It has come down a bit, it has moderated a bit, but you can see as compared to say 2 years ago or even 5 years ago, it is up 4 times. Okay, so coal prices are still high because the inflation problem has not been resolved yet. So Joe Energy seems like it's still enjoying this high price, high volume kind of business cycle. Okay, these tend to be cyclical, right? Because we don't know when the demand will come down and when the certain coal export policies in Indonesia will change, or import policy from China will change. Okay, because they're very dependent on the China demand. Okay, because at one point in time, Indonesia actually banned, not say ban, restrict exports of coal, because Indonesia also need the coal. Okay, but now it's been lifted, right? And because of the exceptional result, right? No matter what fundamental metrics you use, they look damn cheap. You look at the dividend yield, 32%, right? It's crazy because they give out special dividends. And then the payout ratio is only 0.5. That means they really earn a lot of money. Okay, to give you a yield of 32%, that's pretty crazy, right? And the P/E ratio is just 2, low single digit, average 10 years is 5, right? So it looks very cheap. But you, again, similar case as Wilma, because of the current inflation period, their numbers generally looks very good, but it doesn't mean that it's going to stay like that for many years to come. Okay, this is the chart, and I want to show you not just the fundamental analysis, but I also want to show you the technical analysis. So the obvious thing is that yes, the share price has gone up a lot. Probably if we look at here, it's about 0.05, now it's 0.4. That's like 8 times, right? That's like 8 times return, or 100%, 800%. Okay, gain in a span of a year plus, a year and a half. Right, so that's phenomenon. Okay, but it is driven by fundamentals, as you can see, right? It's not just people crazily buying the stock up. There is some reason why the stock price is overperforming, okay, outperforming, because of the fundamental reasons, right? But if you take a look at the technical analysis, yes, the trend is in generally still up, but there is some heavy drawdown here, okay, and there's some recovery. But if they can't break this new high, that means the momentum might be dead. Okay, I have another momentum indicator over here which shows that the strength is not high. right? So the chances of it like going higher, come down a bit and break this, is not as high. Okay, so it might just stay here or it might even go down, right? Because it get teased over at the 200-day moving average. Okay, this is a 200-day moving average, right? So it seems like it's very near the support and it can't break that new high. You have another trend line over here. Sorry for not drawing very straight. Okay, you have a triangle, right? So either you break here or you break here. Okay, so it's in a very uncertain period, right? So from a technical analysis perspective, it might be, top out already. Okay, even though the fundamentals looks very cheap, right? So this is another thing that you must be wary of when it comes to cyclical companies, because their results always look good, always look great during an inflationary period. Okay, so this will be in tandem with what your views of inflation is going to be in the next few months at least. Okay, next company, another Malaysian company, and Top Glove. This is the largest those kind of synthetic glove company in the world, right? Because in Malaysia, they have very huge rubber plantation since the British era, right? So they grow a lot of rubber plants, rubber trees, and that's why they have a lot of rubber products. And one of them is these gloves. Okay, so not just Top Glove, you have like Riverstone, you have Superlaga. There's a lot of all these glove companies in Malaysia, right? So they are the principal exporter of this glove to the rest of the world. And we all know that all these medical supplies were highly demanded during the COVID period, and their share price also shot through the roof. Okay, this is also very unusual. This rise is even faster. This is like 10x. Okay, 10x in how many months? 1 month, 2 months, about 3 months. Okay, it's crazy. Okay, during the COVID period, I know the market has been like really unbelievable, and I think a lot of people were interested in markets as well, right? So a lot of money were dumped inside, and some of these stocks, they are not as liquid, right? So sudden surge of demand, the share price will shoot up a lot. Okay, so that was what happened. But the story turned, right? At the end of 2020, it just went all the way down, even lower than pre-COVID period. Okay, because now the problem is reversed. Okay, the problem is reversed because the demand tanked after the COVID period, right? The customers were still holding the excess stock. Okay, and that caused the demand to drop drastically, and that's why the selling price also declined, right? And that is where it becomes very hard for them to sell more gloves at this period. Okay, so every time the results come out, the quality results come out, they were not good. Okay, and that caused the share price to drive down even further. Okay, and so some of the investors who really bought near the high, they also want to exit, right? So as their hope gets dashed, they will rush through the door whenever opportunity comes. Okay, so that currently has some selling pressure. So I'll say that this Top Glove is a cyclical company. Okay, and for the price to rebound, it requires probably for glove demand to normalize and price to stabilize. Okay, so the current customers need to expand the stock that they are holding right now, and they start to buy again, and that's where the normalizations will happen. Otherwise, maybe the next pandemic comes again, this stock will run, right? Because suddenly the demand comes up a lot more, and they need to ramp up the demand, ramp up the supply to meet the demand. Okay, so either whichever happens first. Okay. Next company, Jardine C&C. This is a Singapore-based company, but it is very regional. They have presence in almost every country in ASEAN. Okay, and their focus is on automotive business. Okay, but I would say that is their revenue. They do have a lot of investments beyond automotive. Okay, so for example, like in Thailand, they have cement. In Vietnam, they even have Vina Milk, which is top or the biggest milk company in Vietnam. Okay, but beyond this, beside this investment, mostly what you see is the automotive, right? Astra is the key asset in Indonesia. They distribute a lot of cars in Indonesia, and then Cycle and Carriage in Singapore, Malaysia, Myanmar. Right, so you can see that they do have a very good overall exposure in Southeast Asia. Okay, almost like really a Southeast Asian stock itself. And the share price, after beaten down for a long time, this year did fantastically well, right? This year alone is up 72%. As the market go down, right? And this stock has been going up and up and up, which is quite unusual. But if you compare 5 years ago price, okay, if someone invested 5 years ago today, despite the rise, is still losing money. Okay, because they suffer a big drop during COVID period. Okay, and then this start of this year they started to recover, right? So you can say that the recovery started late, right? This 72% was late, okay, but nonetheless it recovered, and today it is still below the 5 years price 5 years ago, right? So this I would say is a value stock. Okay, that means they are up and down. It might be more range bound, not really exacerbating growth. Okay, more like an investment holding company having a myriad of businesses in the Southeast Asia region. Okay, and for value stocks, one way to look at it to know when to enter is to look at their trading range, right? So I'm using the PE ratio. This blue line is the plot of the PE ratio across time over a span of 5 years. This is also taken from Tiger Brokers, right? So as I said, there are some useful tools that you can use over there. This is also another one of my favorite. And how to read this is that you can see that this is like the median, okay, or you can say that's the average P ratio, and this is the +1 standard deviation. If you know your statistics, if you remember, right? So there is a amount that goes above the average, and then there's another amount that goes below the average. You call it -1 standard deviation, right? So when the blue line is at -1 standard deviation, that's where it becomes undervalued. That becomes an entry point. Yeah, sometimes you buy, it can go lower, but it's low enough. Right? You can see it's low enough over the span of 5 years. And then when the price hit the red line, you can sell. Okay. So that is how you do the range bound. If you don't want to sell so late, you want to sell the yellow line, is also possible. Right? So it depends on how you want to sell a profit target. But this is one way to know whether a stock is undervalued and how do you play the range, where do you buy and sell. All right, so for CNC, you can see that now currently it's not at the green line, it's not at -1 standard deviation, but it's also not say very expensive. Okay, so up to you. You can wait until you hit the green line, right? But it may not reverse back, right? It may just go up, okay, or it may just stay here for a while, and then decide where the next course of action is. Okay, so obviously, if the P ratio is the green line, is a no-brainer, right? So you're interested, then you can enter. Okay, but now it's a bit not here, not there, slightly undervalued. Right? Next one, another Malaysian company, Silver Lake Axis. This is a tech company. You can see that it focuses on making software for financial institutions. And they also say that 40% of the 20 largest banks in Southeast Asia are their customers. Okay, so a lot of the probably your Maybank, given that is the biggest bank in Malaysia, right? So this is probably their customer as well, right? So most of the again customers are in Southeast Asia, right? Even though they do show that some of the softwares are being sold to North America, to UK as well, right, to Australia, but majority are actually in Southeast Asia. Okay, so this is their 5 years revenue from 2018 to 2022. So for this company, they have reported their 2022. Likely, maybe they end in June, right, their financial year. So you can see that the growth isn't very steady, right, ups and down, but over a span of 5 years, it does exhibit a steady growth of 6% per year. Okay, and another positive thing to look at this Silver Lake Axis is that they have dabbled their toes into fintech. Maybe dabble the toes, not really right. They went into fintech in a rather big way. They have invested in companies and they have developed new platforms, right? InsurTech. Okay, this is Fermion. Is meant to be sold to insurance company. Okay, it's not meant for consumers. They don't do consumers, they do B2B. They sell to other institutions, right? So this is to target the insurance companies. And if I don't remember wrongly, what they do is for them to have a claim system, right? So they're selling them a insurance claiming system to make it easy, so that the institution don't need to develop it themselves. They can just use this, and their customer can straight away make claims a lot easier with this system. Okay, so that's what they are on right now. And another one is a digital identity, okay, called Infotech. They also acquired this company, right? So they are moving to the software as a service, subscription-based fintech businesses, which is a logical extension of their current business, right? Because maybe a lot of their softwares that have been selling for that last 1 or 2 decades are a bit more legacy, older. Now they want newer softwares to be available for different kind of companies, right? Different kind of customers. Okay, so that would help them expand their business further, right? So that is something to look out for, right? Because as I said, majority of companies in Southeast Asia, they are not so tech driven, but in this case, Silver Lake Axis do have some elements of that. So it's a steady growth at this point in time, right? It's fairly valued. Again, it's not for the dividend yield, although it does give some dividend. The payout ratio is very low, 0.24, similar to many of the the steady growers that I showed you just now. The P ratio at 16 is average 17, 10-year average is 17, so it's about fair value. Okay, so it's neither undervalued or overvalued at this point in time. Okay. And this is the second last one, okay, the Hourglass, a Singapore-based company, but 91% of the revenue comes from Southeast Asia. As you can see, they sell luxury watches. Okay, so this is maybe some of you are into watches, and this company you should be quite familiar with, right? So same thing, they were victims of COVID, right? And especially 2021, okay, where there was still lockdown going on, and that's where the revenue comes down, right? Because a lot of a good part of their revenue comes from tourists. Okay, so revenue 5-year average growth rate is about 8.2%. Okay, so rather almost close to 10, so rather fast, and they have exceptional year in 2022. Okay, and the explanation was because there was a rising demand for luxury watches, but the supply don't increase. For example, they Rolexes, all these watches, they are all handmade. It's not like machines, right, where the efficiency of creating all these watches are very fast. So when it's handmade, the craftsmanship, all this, you just cannot increase the supply that well. And with the rising demand, what happened was that it caused the prices to go up as well. Okay, that's why their revenue went up, the margin went up. Okay, so they did say in 2019 they saw that the demand was 3.2 times the supply, but come 2022 the imbalance was multiplied by 2, right? 7x. Okay, demand was 7 times the supply. There was a long wait list. People are not getting their watches, and it's not like you want to buy the watch, you can just walk in the shop and you can buy. You actually need to build relationship with the salesperson, and because of the limited supply, they will select their clients who they're going to sell the supply to. Okay, so you might have to buy a lot of those watches that those really not so in demand ones, right, in order for you to get a hot one, right? So it has to develop that kind of relationship. Okay, so that is how they benefit from this kind of demand supply imbalance. Okay, because the price are always steadily going up. But you do hear that in the second-hand market, right, for these luxury watches, the second-hand market actually saw a drop. Okay, but in general, the secondary market, right, prices are higher than the retail. Okay, than what they sell in the like Hourglass shops. Okay, it's just that at the price is usually very hard for you to get unless you build relationship with them. So it's a steady grower, currently fairly valued. Also not really you play, right? Because whenever you have exhibit some growth, right, yeah, most of the returns will come in capital gains. Okay, not so much of the dividend gains. Again, payout ratio is low at 0.27, but the yield is about 3.4%. Okay, because the P ratio is about the fair price, right? 10, current 10-year average is about 9. Okay, so you can see many of these stocks, right, they are not undervalued despite the general market sentiment has not been good. Okay, so you can see the resilience in these kind of companies. The last one for today would be a property developer, right? There are many property developer listed in the region, right? UOL, why I picked this is because it's one of the Straits Times Index component, so it's a blue chip, and 81% revenue come from Singapore, right? And I believe that a lot of investors like Singapore properties. That's why Singapore property is still very hot. It needs more cooling measure to bring down the prices. Okay, so for UOL, they have two arms. One is property investments. That means a lot of these are office, commercial buildings, malls. Okay, they do have quite good location like Marina Square, United Square, all these kind of locations. All right. They could actually spin off the REIT if they want to. Okay, but they have not. They haven't do it means unlikely they will do it in the near future. Then property development, this is their core, right? Because that's where most of the revenue and profits are made. Okay, so about half of their revenue comes from property development in Singapore. Okay, another 8% in China, and the property investment is about 19%. Right, so these are the ones that collect rental, and the rest hotel, all these are small. So I didn't put a picture over here. And this UOL is currently undervalued. Okay, so this is a value stock. Right? For property developer, there's always a boom and bust. Okay, boom and bust, make money during the boom period, don't do so well during the bust period. So their revenue and earnings will also be there. Okay, will also go up and down. And property development, the cycle is very long, right? A few years to buy the land, okay, few years, and then eventually you sell the units, right? You have to complete the construction and you sell the units, okay? Or sometimes you sell before you even at different stages of the construction, right? You also can do that. You can pre-sell it, okay? But between buying the land and get to sell it, usually it take a few years, okay? Not so fast. So when it's very hard to time the cycle, right? So which means that when suddenly a lot of projects get sold, then they have a lot of revenue. When in years that they have less units for sales, then you will see lower revenue. Okay, so they tend to be cyclical in that sense, but they can be very good value play, right? So when the market is down, when the demand is down, when they are not doing so well, then you can get them at an undervalued price, right? So same thing, this is the price to book ratio. I use the book value in this case for property development because the book value is about the properties, right? The value of the properties, and that's essentially the true measure of this kind of property companies, right? Because they have properties and that's where most of the value are derived from. So a PB ratio will work. Okay? And PB ratio tends to be more stable than PE ratio anyway, right? And same principle, right? You look at the three lines on the Tiger app. If the graph is at the green line, means it's undervalued. So it's actually a green line now. Okay, so it's actually undervalued. Right? So again, same thing. You can sell at the yellow line or you can sell at the red line, right? When the price when the price to book ratio reaches that. Okay, so that's one way to look at it. Okay, so this is the summary for today. The ASEAN economy is resilient. We have seen that every country in ASEAN is expecting a positive growth, right? This is not like some other countries, okay, or some other regions, right? That even for US it's like maybe 2%, 2+% growth. China is also about 2+% growth. But you can see some of the countries like Vietnam, Philippines are growing more than 7%. Indonesia is growing more than 5% in terms of the GDP this year. So the economy seems to be a lot stronger, right? Because a lot of people think that ASEAN economy relies on the big brothers, right? True to a big extent, but somehow the domestic market in ASEAN has been supporting well for the economy. And the stocks also held up better than US and China, right? You have Indonesia is still up this year, as compared to US, China has dropped like 20 to 30%, okay, from the start of this year. Okay, so I shared with you 10 stocks from that's ASEAN exposure, but I do tell you that they are not meant to be recommendation or advice. So you do have to do more work and analyze them if you find anything interesting today. Okay, so today is more like to give you a flavor of what's going on and give you an introduction to it. So we saw Emperador, Thai Bev, these are your alcoholic companies, alcohol companies, right? They have hard liquor. Emperador mainly do hard liquor. Thai Bev have a suite of beverages, even including non-liquor, non-alcoholic ones. Wilmar is a vertically integrated palm oil company, right? So and it benefits from inflation. And I'll just skip a bit first because this is related. Geo Energy is also a beneficiary of inflation, right? But they're more specific to coal. Okay, so we are talking about different kind of commodities over here. And for IHH is more defensive, right? Because they do private hospitals. The demand doesn't really change regardless of how the economy turns out. Top Glove current is the biggest synthetic glove company in the world. right? Beneficiary of COVID, but right now they are suffering from the post-COVID impact. The demand for the glove has dropped, and there was still excess stock held by their customers. So the prices have also fallen. So they need to have some recovery or some stabilization of the prices first before you can see the share price coming back up. Then Jardine CNC is an automotive distributor in Southeast Asia. They also have investments in like cement company, milk company, but they are a very well diversified Southeast Asian exposure at the moment. Silver Axis sells software, right, to financial institutions. We talk about their pivot to fintech as well. And Hourglass is luxury watches retailer, benefiting from the surge in demand, but supply is fixed, and that's why they enjoy price increment. And lastly, we have a property developer come investment holding property investor, UOL. It's a blue chip company, right? So some of these are STI component, right? STI, IHH, I think it's STI. Let me just check. Did I put a label over there? IHH. No, I didn't put. I remember it was STI. Okay. Never mind, we skip that. So sorry, UOL is also a STI component. CNC is also STI, right? So actually at least five, right? I think IHH is also either 5 or 6. Out of these 10 are blue chip companies, which have but these 10 are well represented among the ASEAN countries. Okay, great. It was almost an hour. All right. Let me see. How do I get to your questions? Is it via? Are you watching it via YouTube? Because I don't see your question over this thingy. If we have some questions, we can answer them. Let me see if I can get to those questions. Okay. I think you're watching through YouTube Live. Yes. Okay. Any question? Oh, I don't see any chat. Okay. Anyway, I don't see any questions. So I take it as there's no question. And I'll just end here. Right. Anyway, it's about an hour already. And thanks for spending time in this session. So hopefully it has been enlightening for you. You know, you learn a few new things, learn a few new Tiger features, how to look at these stocks, different categorization, introduction to ASEAN stocks that have been more resilient this year compared to US and China's counters, right? So thank you for staying with me, and thank you for coming, and hopefully I can share more things with you in the future. Thank you and good night.